So how many of you have an iPhone? Okay, this is an iPhone. Apple's a disgusting company, but okay, whatever. Don't get me started on big tech. I know a lot of you work for big tech companies. This iPhone cost $1,500, okay? Apple is so good, they're masterful at getting us to constantly buy new things from them. I mean, it's amazing that a tech company that makes hardware will get me to spend thousands of dollars every year on average. So think about it. Maybe you buy a new phone every other phone, right? That's what I do. I buy it every other cycle usually, right? Because the phones are so good, they last a lot longer now, which they probably hate. But you buy a new phone every other time, okay? So if you spend $1,000, that's $500 a year on average. You buy, if you have a laptop, you buy a new laptop maybe every 3 years, right? Or every 4 years, right? And so, you know, if that costs $2,000, that's $500 a year, maybe on average. So now you've spent $1,000 a year with Apple, then you've got all these subscriptions that they're milking you for, right? And you're paying for that. And Apple can't get anywhere near the share of income we can get as real estate investors. The most valuable company on the planet. I mean, what is Apple worth now? $4 trillion? And we get a larger share of someone's income than Apple by a long shot. I mean, really just appreciate that for a moment. It's an incredible thing. And we get to outsource the debt responsibility to the tenants. The government gives us huge tax breaks. They subsidize cheap money. And think about the cost of the money, right? Everybody's complaining that interest rates are so high. When I got into the real estate business, don't look it up, interest rates were 14%, okay? That's when I started, and everybody thought that was so cheap because they came down from 18%. Okay, yeah. I mean, compared to what, right? It's cheap. But, you know, these are faulty comparisons. When people put this stuff on social media or say this on a podcast, obviously real estate was way cheaper back then. So it's a lot more expensive today, no question, right? But the real cost of the interest rate is the rate minus the stated inflation rate, but really it's the real inflation rate. So if we believe inflation is around 3% and we pay 6.5%, our mortgage only costs 3.5% net. But the real inflation rate is obviously higher than the government tells us. I mean, well, except for the last time. The last quarter might be the one exception because supposedly the last time around, the real inflation rate was actually higher and they were trying to suppress. That's the first time I ever heard of that in my whole life, okay? So that's the net cost. Now, take out your $1,500 phone and go to the calculator app for a second. And let's just take this. This is really simple math, but I'm gonna do it on the calculator. Take 3.5 times 40%. That's 1.4. So now, that's what the government is paying for our interest cost of our mortgage, right? Because we get to deduct, well, really we get to deduct the whole thing. Sometimes they don't understand how to calculate for inflation, the IRS. So sometimes the IRS, the way they manage inflation on your tax return, benefits you and sometimes it hurts you. Okay, here's where it hurts you. Say, for example, a certain administration says, we're gonna keep the tax rate the same. We're not gonna raise taxes. But during that administration, there's a whole bunch of inflation. And your income goes up because you get a cost of living or COLA increase, right? A cost of living adjustment. So your income goes up and it kicks you into the next tax bracket. Taxes actually did increase, even though they didn't increase as a percentage, right? So that's where it hurts you, but a lot of times it benefits you. So take my example, for example, we're taking a 6.5% mortgage times, let's say your combined state and federal tax rate is 40%. If you live in California, it's 51%, but you know, depends. Obviously, it depends on how much money you make and all that stuff. So what is 40% of 6.5%? Equals 2.6%. Remember, there was a 3.5% differential. We take away 2.6%, we take away the stated inflation rate of about 3%. We're only paying 0.9% interest. That's the real interest rate you're paying. You get it? Yes? Okay, good. But wait, there's more. You're not even paying that much because the tenant is paying the 0.9%. As long as you break even on the property, the tenant pays all of the mortgage. The tenant pays all of the debt. So you completely outsource that obligation to somebody else. It is the best deal ever. The only deal in the world as good as income property is a leveraged buyout. Remember in the 80s, you heard the term LBO, leveraged buyout? This made so many people billionaires. It was like incredible. Remember all these names like Carl Icahn and T. Boone Pickens, the super famous corporate raiders that made so much money? Well, their best strategy was the LBO. What they would do is they would find a target company to buy, and if you saw the movie Wall Street, where they bought the company and then they split it off and sell off the parts, right? The corporate raiders, their big strategy was find a company to buy that is as undervalued as we can find, right? And then acquire the company, but load it up with all kinds of debt. Get as much debt as humanly possible against this company. And then make the company pay the debt back for you. You just got a free company. Pretty good deal, right? That's exactly what we do with income property. It's the exact same strategy. We find a property, the best value we can find. We load it up with debt, subsidized by the government, by the way. And then we tell someone else to pay the debt for us, tenant. And then we say to the government, look, that wasn't good enough for me. I want a better deal than that. Give me the best tax write-off ever. Phantom write-off, depreciation, right? This write-off that takes place in the background. And if I want to go visit my properties, I want to deduct the trip, and I want to deduct some other expenses that I would normally have anyway in my life, but I could now call them real estate investor expenses. And so you're going to deduct those too. And then you're going to sell your property someday, and you're not going to pay any tax. You're just going to do a 1031 tax-deferred exchange. And that's the return nobody ever calculates in the deal is the 1031 exchange, because you can trade it all your life and never pay the tax. I've done, I don't know, probably 11 or 12 1031 exchanges in my life, and I never paid any tax. I got to trade the asset for a better asset, or at least I thought it was a better asset, not always, but a better asset, and I didn't pay the government. If I sell my company, I got to pay the government and then use whatever's left over to invest with. If I buy stocks or Bitcoin, I got to pay the government first and then use whatever's left over to reinvest. The massive compounding effect of not paying tax on sale of asset over the course of 10, 20, 30 years is insane.